One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. My name is Alex Mason, and I'm your host. I'm so happy that you're here. Thank you for joining me. This is the place to be if you want to explore and learn with me investment banking concepts, both technical and non-technical. But right now, hey, we're knee deep in accounting. That's what we're doing right now. We're talking about the connections between the three financial statements. If you're unclear about the primary functions of the income statement, the balance sheet, and the cash flow statement, go ahead and rewind a couple of episodes, go back and through the catalog and just study the basics and then come back here. But now we're going to be talking about the connections between the financial statements for a certain type of transactions, which are very important in the life of so many corporations. And we're talking about financing. Remember, as an investment banker, that's going to be your main job. Your main job is to help finance deals. Even if your bank is not providing the financing, you're going to be finding the buyer, you're going to be finding the seller, you're going to be helping sell stock, you're going to be helping companies borrow money in the case of debt capital. And so it's incredibly important to understand how these connections work in the context of investment banking, because that's where you come in. That's where you and I come in so many of these transactions. So what happens when a business borrows money? Let's start with that scenario. So let's say we have a corporation, they want to expand, they want to reinvest, they want to do different things in their business, but they need money and they can't do it with their organic cash flow. So what do? They go to a bank and they get a loan. So what happens first? Well, on the cash flow statement, that's where we're going to start. The cash flow statement, your debt is going to increase. Remember, there's three sections of the cash flow statement: operating cash flow, investing cash flow, and then financing cash flow. This all occurs in the financing cash flow segment. So your principal loan balance is going to show up there, and it's going to be this influx of cash because the company is borrowing new money. And then at the same time, what does that do to the balance sheet? We go over to the balance sheet, cash is going to increase. All of a sudden, you see this big mound of cash on the asset side of the balance sheet. And that's because that's where that principal is going. Now the corporation has money that they can use to reinvest in their business, to do things that they want to do. Usually, if you read an annual report or some kind of press release, the management team will say something like, quote unquote, general corporate purposes, which personally I think is like the most useless thing to say, because that could be literally anything. So from the investor side, it's not usually that helpful. But hey, the company wants cash and they get it through borrowing, right? So that's what happens on the cash flow statement and then also on the asset side of the balance sheets. Now, remember, the balance sheet must balance. So if we have this cash increasing on the asset side, what's going on the liability and the equity side of the balance sheet? Well, we just borrowed a bunch of money for this company, right? So now we have this liability. So that increases our debt on the liability side of the balance sheet by the same amount as cash increases. So this is an important concept. Remember, balance sheet must balance, cash is going up, and your liabilities are also going up. Now, one thing I want to say here, it's worth noting the maturity of the debt. If the debt has to be paid back in less than 1 year, it's considered a current liability, and this can be referred to as short-term debt. Now, if the debt must be paid back more than 1 year from now, which is usually the case, most of these loans are multi-term loans if you look at large corporations, then it's considered long-term debt. And so it's going to show up at different places within the liability section of the balance sheet, depending on the maturity of the debt. So that's just a little nuance there for you when looking at the balance sheet with this kind of transaction. Okay, so that was what happens with the financial statements when a company borrows money. What happens when a company sells stock? This is a little bit of a different transaction. We've got a financing transaction, but instead of using debt, they're using equity. On the cash flow statement, cash is going to increase. Same thing that happened before. This is in the financing cash flow section of the cash flow statement. And then at the same time, on the balance sheet, cash is going to increase on the asset side. So this is literally the same thing that happens when a business borrows money. But what happens here is there's no debt involved. So we don't have to necessarily add a liability on the balance sheet because, hey, the company didn't borrow money, it just issued stock. So that's pretty nice. But keep in mind that this action does have a dilutive effect on the ownership of current shareholders. So the earnings per share of the business will decline unless the company decides to repurchase its own stock in order to offset that dilution. So let me quickly explain that concept because we haven't really talked about dilution, at least in the sense of shares outstanding before on this show yet. So if a company owns some assets and it has 10 shares outstanding, and let's say that you and I each own one share. So we own 1/10 of the company. Well, the company decides, okay, they're going to sell some stock and they're going to double their share count. So they go from 10 shares outstanding to 20 shares outstanding. Well, you and I still each own one share. So instead of owning 1/10 of the company, we now own 1/20th of the company. So our ownership of the whole company went down by 50%. We went from 10% ownership to just 5% ownership. And we didn't do anything. We're just still holding our shares over here as investors. But the business decided to raise extra money from other investors. And so that's how we get this dilutive effect. So no debt involved when you sell stock, but there's a price to pay in terms of equity being split amongst more parties. And so that's something that you should keep in mind. But fundamentally, selling stock and borrowing money, they have very similar effects on the cash flow statement, very similar effects on the balance sheet. Now, that's all we have for you today. What we're going to talk about next is another connection between the financial statements. But we're going to talk about a specific concept that, boy, this one is really important. And I really dug deep into this one because this is one that I was less familiar with and had to get familiar with it. We're going to be talking about depreciation and amortization in the next episode. But until then, this has been Investment Banking Insights. My name is Alex Mason, and I am your host. I'll see you next time.